Hello, everybody. In this session, we are talking about cost of goods sold or COGS. Cost of goods sold measures the direct costs incurred in the production of any goods or services. It includes material costs, direct labor costs, and direct factory overheads, and is directly proportional to revenue. As revenue increases, more resources are required to produce the goods or service. COGS is the second line item appearing on the income statement, coming right after sales revenue. COGS is deducted from revenue to find gross profit. Cost of goods sold consists of all the costs associated with producing the goods or providing the services offered by the company. For goods, these costs may include the variable costs involved in manufacturing products such as raw materials and labor. They may also include fixed costs such as factory overhead, storage costs, and depending on the relevant accounting policies, sometimes depreciation expense. COGS does not include general selling expenses such as management salaries and advertising expenses. These costs will fall below the gross profit line under the selling, general, and administrative expense section. And then we move to the importance of COGS in business. The cost of goods sold or COGS is a vital metric for any business as it directly affects profitability. By understanding COGS, businesses can accurately determine their gross profit and make informed pricing decisions. Lowering COGS can lead to higher profits, while an increase may signal inefficiencies or rising costs. COGS also plays a key role in tax calculation as it reduces taxable income, leading to potential savings. Additionally, tracking COGS helps businesses assess production efficiency, manage inventory more effectively, and identify areas where cost control can be improved, ultimately contributing to better financial planning and strategic decision making. And then we move to business metrics that use cost of goods sold. Understanding your company's COGS is an important step on the path to understanding its overall health. While informative, On its own, COGS is also a critical input to other key performance metrics such as gross profit, operating expenses, overhead costs, and variable costs. We start from the first, gross profit. Gross profit or gross income is the profit your business makes after subtracting what it costs to produce and sell your products or services. This is where COGS comes in. COGS is subtracted from your overall revenue or sales in order to calculate your gross profit or gross profit margin. Gross profit keeps a pulse on your company's efficiency in using both supplies and labor to bring your products or services to customers. And then second, variable costs. And these expenses include all of the variable direct costs in COGS, but exclude direct. Fixed overhead costs, variable costs are affected by your business activity, and as the name implies, they can fluctuate from month to month. Variable costs are considered part of the costs that contribute to overall COGS. And then the third, operating expenses. Operating expenses are exactly how they sound. They are the cost of running your business normal operations that usually cannot be avoided. Understanding your operating expenses will help you better manage your cash flow and streamline operations. Operating expenses are not included in COGS. And then the fourth, overhead costs. Overhead costs are the actual expenses to run your business outside of production and operating costs. Overhead costs are easy to overlook because they are not directly tied to generating revenue, but they should be audited on a regular basis to reduce unnecessary costs and increase profitability. Overhead costs are most commonly listed as a separate line item from COGS. And then how to calculate COGS? Calculating the cost of goods sold involves adding up all the direct costs associated with the production or acquisition of goods during a specific period. The formula for calculating COGS is opening inventory plus purchases and minus closing inventory, where opening inventory is the inventory value at the beginning of the accounting period. And then the purchases is the cost of additional inventory purchased during the accounting period. And closing inventory is the inventory value at the end of the accounting period. By subtracting the closing inventory from the sum of the opening inventory and purchases, a business can determine the total cost of goods sold and sold during the period. And then how to use the cost of goods sold calculation. The first, determine profitability. The COGS calculation helps you determine the profit you make on each sale, understand which products are most profitable, and help you set the best price. This ultimately helps you make smarter inventory decisions that reduce carrying costs, prevent obsolete inventory, and maximize space. And then the second, keep track of expenses. A product requires materials and parts, not to mention the fixed costs, the labor, factory overhead, rent, equipment, electricity to run the operations, employees to sell said products in your store, as well as sales, marketing, and finance. These are all expenses that contribute to the end cost of the product. Expenses you need to keep track of to ensure that you are making a healthy gross profit and that you can accurately price products and keep healthy margins. I think it is enough for this session. Thanks for watching, and don't forget, give this channel with your like, comment, subscribe, and share. Thank you.